The mechanics of the current market have developed a distinct dislocation. Right now, investors are holding common equity positions yielding 4.5%, while preferred shares from the exact same company are paying 7.25%. This chart shows the discrepancy. Column A is the common stock block at 4.5%. Column B is the preferred share block from that same issuer at 7.25%. Both yields are funded by the same corporate cash flow. A gap this wide typically signals financial distress, but the underlying business data in these sectors remains stable. The divergence is a function of the current macroeconomic interest rate environment, which has shifted the pricing of fixed income instruments globally. While common equity prices reflect earnings expectations and growth projections, preferred equity is priced against current fixed income rates. This rate-driven dislocation has opened a specific window for what we call a priority swap. By shifting capital from common to preferred shares in targeted sectors, an investor can upgrade their safety profile while significantly increasing their current income. Identifying these opportunities requires mapping the corporate capital stack to find where the priority layer offers a profile that the common equity cannot match. This process begins with the bedrock of corporate finance, the hierarchy of how a company structures its funding. This four-tier model represents the corporate capital stack, dictating payment order. Top tiers, secured and unsecured debt, hold highest priority. At the bottom sits common equity, home to most retail investors. Our target is the tier immediately above it, preferred equity, home of priority shares. The legal standing of these bottom two tiers is different. A board of directors can cut or suspend a common dividend at any time without triggering a legal default. Preferred dividends are contractually senior. The company is legally required to pay them in full before any distribution can be made to common shareholders. This structural seniority becomes absolutely critical for investors when a difficult operating environment severely compresses a company's free cash flow. As cash flow restricts, it can run dry before reaching the common equity layer. Because the preferred layer sits higher, its distributions remain covered. We calculate this safety margin by dividing the total annual preferred dividend obligation by operating cash flow. This ratio allows us to mathematically prove exactly how much cash flow compression a preferred share can absorb before the dividend is at risk. Moving to the preferred layer provides a structural guarantee of income survival in economic scenarios that would likely force a common dividend suspension. However, this yield premium exists because preferred shares carry specific limitations that common stocks do not. Preferred shares do not appreciate as the business grows. They are par value instruments that function more like fixed income. This introduces call risk. Issuers typically have the right to redeem these shares at their par value after a specified date, often 5 years from issuance. This timeline shows how purchase price interacts with redemption value. Buying a share today at a premium of $103 means redemption at the $100 par value. That $3 capital loss effectively reduces your total income from the coupon payments. Because of this, a swap decision cannot be based on the headline current yield. The required metric is yield to call, which accounts for any capital loss at redemption and annualizes it against your entry price. The swap only remains viable if the yield to call meaningfully exceeds the common equity dividend yield. Without this calculation, a perceived income upgrade can result in a guaranteed capital loss that negates the entire advantage of the move. The final filter in this model is the after-tax net yield differential. Dividends from standard domestic corporations usually receive favorable long-term capital gains tax treatment for both common and preferred shares. However, in pass-through structures like REITs, preferred dividends are frequently taxed at your full marginal rate as ordinary income. Comparing these pipelines, Pipeline A has a 5.5% common dividend at a 15% tax rate. Pipeline B has a 7% preferred dividend at 22%. After taxes, the common nets 4.68%, the preferred nets 5.46%. The initial 1.5% yield advantage shrinks to 0.78% once the ordinary income tax penalty is applied. When taxes compress the yield advantage this significantly, the structural priority of the cash flow must be the primary reason for making the swap. Determining the absolute after-tax yield is a non-negotiable step to ensuring the swap provides a genuine improvement. Applying these calculations to a total portfolio allows us to define which common equity positions should be swapped. This matrix sorts stocks by dividend growth on the y-axis, yield on the x-axis. Swap candidates are in the bottom right, flat yields, low growth. These move upward to the preferred layer for better yield. We strictly exclude the high dividend growth quadrant. Common equity is the engine for future income expansion. Preferred shares are the tool for capturing today's maximum fixed yield. These two distinct positions serve complementary functions within the portfolio. When utilized correctly, they create a highly resilient compounding architecture. The current market dislocation enabling this swap is a function of the fixed income rate environment and will not persist indefinitely. Once rates normalize, preferred shares will reprice toward par, and the window for this specific yield premium will close. Executing this swap allows an investor to secure superior contractual protection and higher verified net yield from the same capital, utilizing the structural advantage built into the priority layer of the market.